This is an Uncovered Japan company research report on JACCS, ticker 8584. JACCS is a Japanese consumer credit company built around auto loans and point-of-sale finance, now anchored by a roughly 38% stake from Mitsubishi UFJ. The market sees a leveraged spread business facing higher funding costs and overseas losses. The investment question is whether MUFG support, a strong dealer network, and a new dividend floor can carry earnings through the trough and into recovery. The report's market snapshot uses a reference price of 3,375 yen. JACCS traded at 0.51 times book, with a 5.9% dividend yield. The headline fiscal 2027 earnings multiple is 15.1 times because management guides to a trough, while the report's normalized estimate is about 7.7 times. This is a value and income turnaround, not a clean growth story. And the discount will persist unless the earnings recovery becomes visible. JACCS is what Japan calls a shinpan company, an installment credit house. At a car dealer, clinic, school, or renovation firm, it pays the merchant upfront and collects from the customer over time. Unlike a broker, JACCS carries the receivable on its own balance sheet. Its domestic engine combines auto loans, credit cards, shopping credit, and guarantees for bank loans. Overseas, it provides auto and motorcycle finance across Southeast Asia. The business ultimately depends on transaction volume, funding cost, and credit losses. The segment split exposes the central tension. Domestic operations produce about 87% of revenue and effectively all group operating profit. Auto loans remain the core, supported by cards, shopping credit, and an asset-light guarantee business. Overseas contributes about 13% of revenue, but swung from profit back to a 3.6 billion yen operating loss in fiscal 2025. The long-run motorization opportunity is real, but the report identifies overseas break-even as the largest single swing factor for consolidated return on equity. Operating revenue increased from 164.1 billion yen in fiscal 2022 to a record 192.3 billion in fiscal 2026, roughly 4% annual growth. Yet operating profit peaked at 33.1 billion yen in fiscal 2024 and then fell to 20.4 billion. Overseas losses, weaker domestic margins, and restructuring costs explain why a growing top line has not translated into growing earnings. Investors need margin repair, not simply more receivables. JACCS Durable Advantage is not a consumer brand. It is the network of auto dealers that routes financing at the point of sale, paired with decades of underwriting and collection data. Dealers value fast approvals and reliable sales support, while JACCS needs enough loss history to price thin margin credit safely. MUFG adds a newer layer, cheaper and more resilient funding, stronger credit resources, and potential customer referrals. The forward case depends on those benefits appearing in reported margins rather than remaining strategic language. The MUFG placement changed the balance sheet. JACCS's equity ratio rose from roughly 6% to 7.9%, improving resilience in a business with trillions of yen of receivables and borrowings. But return on equity moved in the opposite direction, falling from above 10% in fiscal 2023 and 2024 to 5.2% in fiscal 2026. More capital is valuable, yet it only creates shareholder value if funding synergies and better operating performance restore returns. Cash flow for a finance company must be read differently from an industrial business. Rapid receivable growth consumes operating cash, even when the underlying loans are profitable. JACCS moved from minus 214 billion yen of operating cash flow in fiscal 2023 to plus 23.1 billion in fiscal 2026, largely because receivable growth slowed. The improvement supports funding stability, but it is not by itself proof of better economics. Credit quality, spreads, and segment profit remain the more important tests. Management's road to fiscal 2028 targets a V-shaped profit recovery. Two levers do most of the work. First, MUFG's cheaper funding, credit expertise, and group referrals must become measurable income. Second, JACCS must stop the overseas losses through select and concentrate restructuring. Capital-like guarantee fees offer a useful bridge because they can grow without expanding the balance sheet as aggressively. The plan is coherent, but both major levers are still unproven, which explains much of the valuation discount. Capital returns are the clearest support in the case. The new policy pays the higher of a 3% dividend on equity or a 40% earnings payout, creating a meaningful floor when profit is depressed. At the report's reference price, the dividend yield was about 5.9%, the highest in its listed consumer credit peer group. The weakness is total return quality. Buybacks have been almost absent, and MUFG's 38% stake creates a genuine minority shareholder governance question. These scenarios are assumption tests, not price targets or investment advice. From the report's 3,375 yen reference price, the 3-year bear case is about 2,700 yen, the base case 3,950, and the bull case 5,400. The range captures a highly leveraged spread business where small changes in funding cost, credit losses, and overseas performance can move equity returns sharply. The most useful indicators are overseas break-even, domestic margin, consolidated ROE, and dividend discipline. To conclude, JACCS combines a defensible auto finance dealer network, deep underwriting experience, and a stronger MUFG-backed balance sheet, with a valuation below half of book and a dividend protected by a new policy floor. The trade-offs are equally clear. Profit is falling, overseas execution is poor, rising rates pressure funding costs, and minority governance deserves scrutiny. The two measurable tests are whether MUFG synergies restore return on equity and whether overseas operations reach break-even. For the complete evidence and source detail, continue with Uncovered Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.